Hello, this is Chuck Carnevale, co-founder of FastGraphs. A subscriber on our forum asked that I evaluate Goodyear tire because he had some questions regarding how the market was treating this stock and whether or not it was a good investment or not. Unfortunately, I don't have the time or the resources to respond to every request that's made by subscribers to evaluate a stock, but I do think the Goodyear Tire and Rubber Company is a great general example of a cyclical stock that I think it might be helpful to understand how I utilize FastGraphs when I'm evaluating a cyclical. But also let me point out that my way is not the only way. This is a tool to think with, and the key is to evaluate what you see when you draw a graph on a fast graph. So let's start here with the Goodyear Tire and Rubber Company. I'm going to take the price off of the graph, and I'm going to take dividends off of the graph as well as a normal PE. Now, the first thing that you see when you're looking at a stock like this is extremely cyclical and inconsistent operating history. You can see back in 1999, we had significant drops in earnings through 2001 coming into the Great Recession. We saw the elimination of the dividend. I'm going to go ahead and add the dividends and the payout ratio. The last dividend was on 2002, and they had cut it prior to eliminating it. And then we didn't start paying a dividend again until 2013. Then we saw some relatively cyclical earnings growth coming into the recession, and once again, as we hit the second recession on this graph, the company's earnings growth collapsed, dropping significantly over the next 2 years. And then more recently, the company's earnings have accelerated to the upside as we've come out of the recession and the economy's improved. First of all, let's put price on the graph. And the thing I want to illustrate here is I want you to notice how price really responds to and even tracks how the company's operating history has performed. Now, as I change time frames here, you're also going to see a difference. If I drop this to an 8-year graph, or let's go 9 years and see what we get. We get 11% growth, and we get a company whose stock price kind of tracks that growth. But I want you to notice that the market normally values this stock at about an 8.9 PE, or at least has since 2012. If I go out there longer term, you see a normal PE of 13, but that includes some of these overvalued situations. So when you're analyzing a cyclical like that, it's important to remember that the dynamics of this tool allow you to evaluate these different time frames, and the adjustments are automatically made. So what I'm learning by looking at this time frame here is that we get an 8 or 9 normal valuation on this stock. So technically at a PE of 6.6, that would look attractive relative to its normal PE of 8.9 as depicted on this time frame. Now, a couple of things I want to point out. We had a significant drop in earnings in 2017, and we've got estimates for earnings growth of 11%, 19%, and 9% for the next couple of years. So let's go down and look at this from the perspective of the normal PE ratio. I'm going to use the blue graph here, and we've got that 11%, 19, and 8.7% growth. Now, if it goes back to a normal PE of 9, you would have a tremendous rate of return possibly out there. Now, the question, of course, is can you trust these analyst estimates? Now, the scorecard for such a cyclical stock is actually not that bad. The company has hit estimates 60% of the time on the 1 year, 80%. Remember now, I've got a 20% margin of error here and a 10%, so it's a little easier to come within a 20% margin than it is a 10. But they also miss it 20% of the time, and that's the nature of a cyclical stock. But if you assume that these forecasts are reasonably correct, this stock would be very attractive now as a long-term, or I'll recant that, not as necessarily as a long-term investment, because you can't trust what earnings are going to do over the long run, as we saw from the history. But for the short to intermediate, and I'm going to call that out to this year end or possibly next year end, this might be a very attractive, I'll call it trade rather than a long-term buy and hold. My point is, and this is my own bias that I'm throwing in here now, I am personally not inclined to invest in a company with this kind of cyclicality. I just don't trust what the business might do going in the future. Now, from a standpoint of what has happened to the price, I see this drop in value rational given the operating results we saw in 2017. So the earnings were down over 20% in 2017. And keep in mind, that's a certainty. That actually has happened. These forecasts are not necessarily a certainty. So once a stock kind of gets a negative momentum, that can work when it's positive momentum, as you see back here in the period 2006 upcoming into, just before the Great Recession by the end of May of 07, a stock can overshoot valuation in either direction. Now, this is a reaction, in my opinion, to the negative earnings we were seeing. It's like investors didn't react, and then they might have finally reacted when the numbers actually came in for the year poorly. That's just an assumption. I want to make that clear. I don't know that what I said is just true. Now, the dividend record here more recently, if I look, go down to the performance results, the dividend since 1999 has been spotty. There's been 44% average growth, but a compounded growth of -11 because we had periods where they cut the dividend out. So let me go into the period here where we've looked at dividends just since they've reinstated a dividend in 2014 and look at the dividend record. And what you have, an aberrant number here. I want to make that clear. So the average growth rate of 105% and the compounded growth of 72% are really aberrations. So let me shorten this just a little bit more and go down and look at the results. Now we've got 25% dividend growth, 26.7 to be precise. And the point is that's probably reasonable considering the short history now that they've been paying a dividend. So the stock has negative sentiment now, but it has become very cheap. So if you're looking for a good long-term or again, short to intermediate term trade, Goodyear might really foot the bill. But now me personally, I would never invest in a stock like Goodyear simply because I don't trust it. I feel the same way about most airline stocks. I feel the same way about even companies in their industry. For example, if you look at the long-term track record of Ford from an operating basis, again, you see this very poor long-term performance. So, we're dealing with stocks here that are very cyclical, very hard to predict. However, I would argue that the stock is excessively cheap here. So, if you're looking to make money and you're willing to watch this stock very closely, it could be a good buy. As I go here into Seeking Alpha and look at how the stock's doing today, it's up almost 1% today. And, it's doing pretty well in a market that's not necessarily great today, but it's doing okay in the short run. And this may be a great time to buy this stock for speculation. If we go back to that 9 PE by year end, you could have a substantial 45% appreciation by December of this year. Of course, that annualizes at 129, but that's only because you're only talking about 6 months. Notice the further out you go, the lower that return goes, but the annualized return would still be strong out to 19, again, assuming these numbers turn out to be reasonably correct, and even out into 2020, the returns would be fabulous. But the point is, investing in a cyclical like this is not for the faint of heart. And what Fast Graphs is really showing you here is that the company is very cyclical and therefore unpredictable, but it's also showing you that the valuation is real low. Because again, when I shorten this time frame, you see that the market has been applying an 8 or 9, 9 to 10, we'll call it, valuation on this stock over the last several years, since 2013 at least. And so if you measure performance, going out there like we did, you could make some money because you could get almost a 50% PE ratio expansion. But again, when you analyze a cyclical stock using Fast Graphs, remember, it's not the price that you're analyzing, it's the fundamentals, the dividend record, the earnings record, etc. And since the stock does pay a dividend, I think it's important to also look at things like operating cash flow. Free cash flow looks like it's going to improve dramatically on Goodyear, although it has been negative in years past. And of course, the company was not paying a dividend during those times when you had negative free cash flow. If I go back to operating cash flow, then once again, you're going to see a very cyclical level of operating cash flow that does turn negative at times, moderately covering the dividends, but it's very cyclical, and there are no forecasts for operating cash flow going forward. It just is what it is. So this is not my cup of tea, but when you're analyzing cyclical stocks, the key is you're looking at the fundamentals, not the price action. The price action will relate to the fundamentals, however, as you can clearly see by looking at Goodyear. This has been Chuck Harville saying, hope you enjoyed this.